Okay. So hopefully no dogs will bark.
I can't promise that, but maybe.
I know. So many. All right. So, hey guys, I'm here with Jason from Fairway Mortgage. I'm so excited. He is going to talk to us today about the process of, how a home buyer would use a renovation loan as one of their loans. Um, I've used these myself. I've seen them go terribly wrong, but lots of times they're a really underutilized tool, I feel like, in our
Mhm.
industry. But kind of all things need to align for them to work. You have to have the right price on the house, the right market to make an offer on a house that needs work. There's a lot of factors in there. So I think we'll just start off letting Jason, just why don't you introduce yourself and kind of walk us through renovation loans 101.
Yeah, absolutely. Thanks for having me. Like Heather said, my name is Jason Paull. I'm with Fairway Independent Mortgage. Been with Fairway about 5 years, but been in lending a little over 12 years now. So definitely have a lot of background in the refi space, the renovation space. This is one of my favorite programs that we get to use just because I'm kind of a sucker for buying dilapidated houses and fixing them up over new construction. And basically you can get brand new, but you could have, you know, a really great neighborhood and a house with really good bones and then just make it what you want. And there's a lot of houses in our area that need updating that were
Yeah.
built in the 90s and haven't been touched since. So
Well, yeah,
yeah,
I was going to add to that. Like the market that we're in, Spokane, has like no shortage of outdated homes
for
that
sure.
need be renovated. And a lot of times, what I love about it is you can get, when you're moving into a house that someone else renovated or, even brand new construction, you really don't get to have a lot of choices. And
Mhm.
this path for someone who wants, something that feels like them
Yeah,
is kind of the only way to do it,
for sure.
unless you have loads of cash, in which case you probably don't watch my videos anyway.
Yeah, this is a great option to keep your cash in your pocket and get the reno that you want. So
Yeah, cool. All right. So, how do these loans work? What do people need to know?
So when you're using it to purchase a home, it's a very similar process to just buying the home outright. Okay, so you're gonna go shopping. Heather's gonna find a perfect house for you. And if you do notice that it needs some renovating or you'd like to do some of those items, basically there's going to be an extra step after you get your offer accepted. So typically you would get an inspection on the property. You can still get an inspection, but we want to get your contractor in there as soon as possible to walk through the property and start putting a bid together for you on all the items that you want to do. So typically, let's say the house is well under your budget. We're going to have a max budget amount. And so we need to work within those constraints. And once we get the bid back, then that's going to go to the appraiser and we're going to order the appraisal just like normal. But he's now going to have this bid in front of him as well. So he's going to be looking for comparable sales like he normally would to see, okay, what's this house worth? But he's also going to be seeing, hey, you're going to be doing X, Y, and Z renovations and that's going to improve the value. So we're actually going to get, okay, here's the value as it sits, and then here's the after improved value. And that's the number that we're going to be basing all of our numbers off of. And so, normal closing for the seller, they're going to get paid whatever you agreed to pay them. But then there's going to be that after improved value that all of your loan numbers are going to be ran off of.
And then, how long do these loans typically take to close?
It depends on the contractor that you use. So we like to partner, with some contractors that have experience with this and can get us bids back quickly. We have closed one in 30 days before. They're very tight. So because we can't order the appraisal until we get the bid back in the
Sure.
correct format. And we want a lot of description in the bid because we want to try and get you as high of a value as possible. Again, so you're not bringing more cash to the table than you need to. And so, yeah, if we can do a 40 to 60-day closing, that just makes it a lot less stressful on everybody. But typically we'll do a longer close and then close as soon as possible once we get everything back. But yeah.
Well, and then have you ever encountered, because the first thing I think of is like, is there room in the neighborhood for you to do the $60,000 renovation project that you want to do?
Mhm.
Like if your house is listed at 400 and you want to put 60 into it, have you ever run into the appraisers like it's just not there? Or
Yeah, that can happen. We've had that in sometimes the clients are like, okay, we're willing to bring in a little bit extra. It's similar to if you get a low appraisal when you're just doing a straight purchase as
That's
well.
true.
And so they can bring the cash difference, or they can back off of what they want to do in the renovation. So we have that flexibility as well, where we say, okay, here's that value based on what you're going to do. Let's take out maybe, if you ever watch like Property Brothers on HGTV. So this is what they use these loans to do that type of property. But if you notice, they'll always do like the kitchen, but then they never touch the bedrooms or things like that. So you may want to do the entire house, but you won't have that in the budget. And so we just focus on the areas that are kind of the top of the list.
Cool. Yeah, I always recommend people start with the main living area, before they do anything else, because that's where you spend so much of your time in the house.
For
And
sure.
that's where you usually see the most return on your investment is with the kitchen and the bathrooms.
Absolutely.
So let's see. So I know there's different kinds of loans. Like I know there's an FHA product and there's a
Mhm.
conventional product. I think there used to be a VA one, but I don't think they do those anymore.
We still do. Yeah, there's a VA
Really?
reno option as well. It's a little bit more stringent on the amount and what you can do. Typically, it's just to cure any VA related items.
Okay.
So yeah, it is, but it is still a good option. But yeah,
That's good
two
to know, though. I actually didn't know that about curing problems because that can be a real deterrent for some VA buyers when they can't
for
find
sure.
something that's like approved. I didn't even know that was one of my options, Jason. That's
Yep.
awesome.
Yeah.
So talk about the difference between the FHA and the conventional.
So the at the base of it is the type of loan that it is. So if you qualify for an FHA type of loan, you're going to go with the FHA renovation. It
They have a
also has a
cap, don't they, on how much you can spend on the reno?
there's two types of FHA, and I probably don't want to go too deep into the weeds. So there's a limited that you're capped on the amount that you can spend, and then there's the more extensive, so the 203K,
Oh,
and then
okay.
you can go above and beyond. The limited doesn't let you do any structural work. It's more cosmetic and keeping it. I believe it's under 35,000.
Yeah.
They change those numbers pretty often, so don't try not to memorize those.
I've always
Um,
heard 35.
yeah, and then you can do the full 203K, which you can, add an extra bedroom or add a second story, similar to the conventional products as well. So both Freddie and Fannie on the conventional side, they each have their own renovation product as well.
Oh, cool. And so do you find that these loans are more expensive for the borrower?
Yeah, they're a little bit more riskier. So that's always going to be reflected in the interest rate being a little bit higher. But most of the time, what we're seeing, so over the last probably 4 years, we've done a handful of these, and they add so much equity to the property that, and we're typically doing them for first time home buyers too, which is really a cool
That's
part. And
amazing.
so they're
Yeah.
doing 3% or 5% down, or on the FHA, they're doing 3.5. But then you're essentially getting the sweat equity that the contractor's putting in. And so you're going to have that after improved value. So within a 6 month time period, you could potentially refinance to a lower interest rate if rates are still trending lower, and then just have that built up equity in there. So
Well, and that would
yes.
I wonder how does that work with the mortgage insurance?
Yeah, if you're on the conventional side, once you hit that 20% equity, if we do a refinance, then you can drop your mortgage insurance.
That's awesome. That's
Mhm.
very cool. So let's talk about like who the contractor is that can work on something like this. Like what are the requirements on the from the contractor?
Yeah, we typically recommend you find a general contractor instead of, trying to be the general contractor and then have a bunch of subs. It just makes it a lot simpler that way. Um,
Sure.
so if you pick one licensed general contractor, we get all of their information, and then in part of their bid process, they'll let us know who the subs are, and then we get their licenses and things like that too. So it can't really be like a handyman or John next door who's going to help you. It has to be an actual contractor, and it also has to, let's say you have a parent who is a general contractor. They can do it for you, but the bid has to be what they would normally bid for somebody else, just in case they get hit by a bus or something like that, we need to make sure
Be
that
able
you
to
have
bring
enough
someone else
money.
in. Who
Exactly.
can
So,
meet those numbers. That makes sense.
yeah.
What about if someone wants to do some of the work themselves and they're like, let's say I'm a plumber and I want to do this work, but I'm going to do all the plumbing, is there any way that
Mhm.
that kind of stuff would work?
Unfortunately, no. There's no self-help. Is kind of how they lay it out. So you can't do any of it yourself. You can potentially, like, after the
Right.
fact, if there's something that isn't going to be a part of it and it's not going to, I'm just thinking of, like, well, I'm a painter, so I'm going to paint the outside of the
Yeah.
house. Well, if that's not part of the initial bid, then once everything's all said and done, then you can come in and do that.
Right. But it's not like you can use money funds from your renovation to pay for
Mhm.
materials or anything like that. You're just doing that on your own
Correct.
as your own project.
Yeah, just a risk thing. Yeah, I think people would try and maybe take advantage of it. So
Can you use these on investment properties?
you can. Yeah, so if you're buying as a primary residence, you can do up to a 4 unit for both FHA and conventional.
Oh my gosh.
So that's a really cool option too, especially when we're talking about first time home buyers. Imagine being a first time home buyer buying a 3 unit building, putting 3.5% down, and financing the renovation costs to maybe fix up the other units. That's a really powerful tool. And then if I'm just an investor wanting to buy like a single family investment property, I can use this as well on the conventional side, not on
Does it
FHA.
have to be owner occupied?
So owner occupied is the 1 to 4 units, and then if it's just a straight investment property, then it needs to be a single unit.
All right. Huh. So I could use this, just Heather the realtor, to flip a house if I wanted to.
It's not a good flip option because it's more expensive, like, than if you went and got a hard money loan. So I typically wouldn't recommend it. It would be a good. So there was actually a recent change in cash out refinances where now you need to have your loan for 12 months before you can do a cash out refinance on a
Okay.
property. And so, what some investors would do is go get a hard money loan. They would use their own cash for the renovation, and then we would come in at the 6 month mark. We would get a new appraisal. We would pull cash out up to the new appraised value, and then they could potentially be in the property for very little cash out of pocket. So if you've ever heard of like the bird
That makes
method,
sense. Yeah.
yeah. So now Freddie and Fannie, they've taken away that ability at the 6 month mark. Now you have to be at the 12 month mark. So this would be a really good product if the investor wanted to buy and hold the property long term and not flip it. Um, but it needs some work. And the
Gotcha.
really cool parts of the renovation is the property could be advertised on the MLS as cash only or conventional, and
Mhm.
we can come in and take a cash only property and make it financeable. So
Yeah,
that gives you some more flexibility as well.
that's true. That's a good point. So we've been talking about it kind of where you would use these loans if you're just like a first time home buyer or someone buying a house.
Mhm.
Do people ever use these loans as a tool for renovating a house they already own?
Mhm. Yeah, you can do a refinance. Yeah, so if you want to stick in your home that maybe you bought a couple years ago, we would just do a refinance of your first mortgage, and then similar process as if you were buying it, like we talked about earlier. You get the bids collected, we give those to the appraiser, and the really cool part is it's not considered a cash out refinance, so the rates are better than a straight cash out refinance. So kind of the big difference between those two is, if we're going to do a cash out refinance to do the remodel, or a popular thing too is to go get a home equity line of credit and then pull off of that to do your remodel.
Those are
Home
expensive too.
They can be, yeah. So they're, I think right now their rates are in the seven, maybe upper sevens, pushing 8%, and they're variable. So they're like a credit card where the rates are going to move when the Fed moves their rates. Variable rates are going to move as well. Um, and you have a second payment. So you have your first mortgage plus the HELOC. And so you're going to have two payments. This allows you to roll it all into one payment, which is really nice. But even so, with the HELOC or a cash out, you're looking at the current value of the home in which you can tap into that equity. The renovation is looking at the future value. So you can potentially unlock a lot more cash, depending on how much renovating you want to do.
Well, and
So
then that's nice because you can still kind of protect your equity, hopefully, where you're not, lots of us who have been in our houses for 5 or more years at this point just got huge paychecks with the crazy inflation over the last few years.
right,
But it's nice where if like on it with a renovation loan where they're basing it on the after repair value, you're not having to, hopefully you're still be able to give yourself a good cushion in there where you don't have to, you can still
sure,
be well within 20% equity or more.
absolutely, yeah.
So cool. So tell me what happens if, this happens on all of my flips every single time something happens where the plumber is going to be 3 weeks behind or something doesn't happen on schedule, or we open up a wall and we're like, oh no, we need $5,000 more to deal with this
Right.
hilarious problem that we just found. So how do you handle stuff like that during a renovation loan?
Yeah, so it's a pretty lenient time period, I think, and I've done quite a few flips as well. So the contractor needs to start within 60 days of closing. So if you're purchasing the house or if we're doing the refinance, within 60 days of the loan closing, because when the loan closes, the money that's set aside for the renovation piece goes into an escrow account. So we're holding on to the money and we're going to pay the contractor for you. So they need to start within 60 days. That's pretty lenient. They can show up, they can get drawings started. It's it's pretty liberal with that interpretation of starting. So because some contractors are 2 3 months out, right? If it's a
Yeah.
good one. So we want to make sure that they're within a timeline at least if they can start or start doing some demo work or something like that. And then ideally they'd be done with construction within 6 months. So, and even the 6 month is a little bit lenient, if there are delays, I mean, it's getting better, but still getting windows is a ways out right now. So, I've heard garage doors and things like that. So depending on what you're doing, we're pretty flexible, but yeah, ideally it would be wrapped up within 6 months. And then in terms of cost, so if you're buying a house that needs a lot of fixing up and maybe the power's been turned off, a lot of bank-owned properties are like that, or they're winterized, we add a 15% contingency on top of your bid. And so that money will hopefully be enough cushion. And then if the utilities and everything are on, we only need to do a 10% contingency. So we get that added in.
Okay. So let's say if something we bid on ends up coming up cheaper. So, because that's
Mhm.
something we'll frequently negotiate with like a client, or with when I'm helping a seller, we'll talk about like, okay, it's gonna cost you $15,000. But then it's like, oh, look, we saved money on this, whatever, landscaping fee, or we decided not to do
Mhm.
something. To my mind and the seller's mind, it's like, cool, let's take that $3,500 and put it towards something else. How does that work in your world?
Yeah. Yeah, you can do that. So if the contractor's like, hey, we changed our mind, we don't want to do X, and now we're going to do Y, we just need invoices, and as long as it's within the scope of the project, um, yeah, it's
Cool.
pretty flexible from that
Right,
point.
that is awesome.
Or even if you just get to the end of the project and you have leftover funds,
Like
maybe
you
we
don't use
held
your
the
contingency maybe or whatever.
exactly. Yeah. So
What
that
happens to that
money,
cash?
it gets applied towards the loan. So it just
Okay,
goes back into your equity basically and pays your loan down.
that's cool.
Yeah.
Let's see. Oh, one other thing I wanted to talk to you about is, a lot of I know a lot of your clients are using, like buy down strategies to deal with the higher interest rates. Can you buy down your interest rate if you're doing a renovation loan as well?
You can't do a temporary buy down like a 2-1 or a 1-0, but you can do a permanent buy down. So if we do need to target a specific payment, we can. And in today's market, if you're able to find a property where the seller is going to help you, that's kind of where we would suggest, yeah, let's use some of that seller money to buy a little bit lower interest rate.
Mhm.
Otherwise, this could be looked at as a shorter term option. And so if rates do
Like
continue
the
to
goal would
drop,
be to refinance eventually.
exactly.
That's just so hard because who knows what the rates are going to do.
Right. Yeah. So
Everyone
we
I
want to
listen
find
to
that
is
sweet
like, I
spot.
don't know, 7%, 15%. We don't know what's going to happen.
Yeah. Yeah, exactly. Yeah, my crystal ball's broken. So, hopefully they're gonna trend lower. Most people are projecting that we'll be back, in the fives by the end of the year. So, um, yeah. See.
Let's see. Anything else that you can think of that like, gosh, I really wish people knew this before they started?
I think a big concern that we've had some clients is okay, we want to undertake this big project, the perfect house, but we're not gonna be able to live there. We don't want to live there during the renovation. You can actually finance up to 6 months of payments into your renovation budget. So we just had some clients we closed in October. They had a rental that they were month to month on. They found the perfect house that they were redoing the basement into an accessory dwelling unit. It had a separate entrance off the back, and so they had it closed off. We did about $150,000 renovation to get that completed, but they weren't going to be able to live there for 6 months. We financed 6 months of payments into the renovation budget, so they didn't have to pay rent and a mortgage
Oh,
at the
where
same
were you
time.
10 years ago when I bought my house, Jason?
Yeah, so
So
that's a really cool one for a lot of people.
yeah. So those of you guys who know me, you know that I bought the house that we're in now using one of these loan products. And I don't think it was like as they're still hardly ever used. I feel like people don't really
Hmm.
utilize this tool, partly because I think lenders aren't crazy about promoting them because
Yeah,
they're a lot of work, and there's so many
yeah.
moving parts and so many things that can just kind of go wrong or be difficult. But I really had to like kind of force everything together. I had a realtor who had never done one. I had a lender who was whatever. I had a contractor who'd done a couple of them. But you're also asking your contractor to more or less float the cost of the renovation
Hmm.
until they're done, because frequently the way that the payments come doesn't sync up with when work gets done and things like that. So potentially, if they're doing a lot of these projects, they've got a lot of cash sitting out there, that can make it
Hmm.
hard. So there's like 1,000 things I wish I would have known when I had done this before. So I'm
Yeah.
excited to start hopefully partnering with you this year and helping people like get educated on how to use this product, because I think it is the way to like get into the neighborhood that you want to be in,
Hmm.
you know, without that terrifying risk of like, okay, I really don't want to renovate a kitchen by myself.
Hmm.
So I just
In the
such a great
cost
option.
too. Yeah, exactly. Yeah. I mean, but even most clients are like, hey, I love this house, and maybe they have a 5% down payment saved up, but they don't have the extra 50 to 60,000 that's
Exactly.
going to take to do the reno. So this allows them to stick with their 5% down just based on a little bit higher amount. Um, yeah, so like going back to that example, those guys did $150,000 reno budget. They came to the table with about 30,000, which was their 5% down payment, which
Insane.
is awesome, right? So
That's awesome.
um yeah, so really cool. I mean, the reason that I love doing loans is we can just transform people's lives and help them build wealth. And this is a product that does that hands down better than any other. So that's kind of why it's my favorite. But it is more work, but yeah, it's more fun to see the afters. So,
Yeah, that's awesome. All right. Well, I highly recommend Jason. He's an awesome, awesome lender. He's super good at creative thinking and problem solving. And really just like looks at your situation and really takes the time to walk through what your goals are and helps you figure out those things. So, and he's just fun to talk to.
thanks.
Got a great team. So anyway, hopefully you guys will do lots of these loans this year and we'll make Spokane a little bit more beautiful.
Yeah, absolutely. Thanks for having me.
Yeah, you bet.
Bye.